Organizer, and thanks for having me here. Do you mind if I speak this presentation in English? Okay. So today the topic that I'm going to talk about, and also Emily will join me later, is generally we are going to talk about the systemic risk. So for you, I know that systemic risk is not something new. So perhaps you have already familiar with some notions and concept about the systemic risk. But let me quote what George Orwell said. So the restatement of the obvious is the first duty of the intelligent man. I'm not going to say I'm an intelligent man, but I just try to be. Okay, so the first one, now let's talk about the introduction. When we talk about the systemic risk, so the systemic risk is sometimes confused with the systematic risk. So what's the difference between the two? And the distinction between the systemic risk and the systematic risk is crucial for both the economic interpretation and for the risk quantification. Now, the systematic risk is the exposure of an individual financial institution facing a given shock in the system. That is, we take the shock on the system is totally exogenous. Okay. And if you want to present it in a mathematical formula, is that the return of the system is something given, conditional. And what is the exposure for a specific institution I here, for example? And to tackle this issue, the regulator always implement the stress test, for example, that what the ECB just implemented last year is a typical stress test that tackle the issue of systematic risk. Okay, now the systemic risk is in a different direction here. It's the contagion risk to the financial system to which each financial institution contributes. So that is the shock here. The shock on the whole system is endogenous. Endogenous by what? Endogenous by the failure of the single institution in this case. So, okay, from that we see that some financial institutions have the systemic risk contribution to the system. What the regulators they will do, usually they just to impose a systemic capital surcharge in this case. That's what we have seen for the bank already. So the question now is that there is a debate on should we or how we impose the systemic capital surcharge in the insurance sector as well. Okay. Now it's the capital surcharge. So why the capital requirements are needed for the financial institution? We know from the very basic corporate finance theory that the Modigliani-Miller theorem tells us that the capital structure will not affect the firm's value. It is equivalent to say if I have €5 from my right pocket, I put it in my left pocket. My personal wealth, it doesn't change. And by saying that, we can win the Nobel Prize. But what the Modigliani and Miller statement is in a frictionless world full of information and complete market, etc. This contrasts sharply the intuition what we have seen. The financial institution have access to low-cost debt financing. That gives them the incentive to leverage their balance sheets, to have the highest leverage as possible. If we don't put the capital into their balance sheet, in theory, the whole liability side of the balance sheet would be fulfilled by debt only. So we need capital requirement in this case for those financial institutions. And the role of the capital requirements is twofold. The first one, it can be used as a monitoring tool to distort the behavior, the risk-taking behavior of the banker on the one hand. On the other hand, is that it also can be used for loss absorption purpose to reduce the solvency risk of the financial institution. Okay, when we have enough capital requirement, is that enough to mitigate all the risk that we have? The answer is not obvious. The liquidity risk played a major role in the great financial crisis as well. As we can see from the open letter written by the Christopher Cox, the chairman of the US SEC, he just mentioned that the fate of the bear's turn was the result of a lack of confidence, not a lack of capital. And he also mentioned that the firm had a capital cushion well above what the Basel II requirement required at that time. However, the failure is mainly comes from the counterparty withdrawals and credit denial, resulting a loss of liquidity and not inadequate capital. So this was the problem that we have to think about. There are some financial institutions, they are solvent, but they're illiquid in this case. But overall, they are going to, they will jump into the credit risk, they are going to default. So the liquidity risk is a main measure for the great financial crisis. So what is this liquidity risk then? Now, if we look at the balance sheet of a financial institution, the left-hand side is the asset. And on the right side, we have the equity and also debt. So what I call here the market liquidity risk, which is linked to the asset side of the balance sheet of the financial institution. That is, the ability of raising funds from the market decreased at that case. And also the funding liquidity risk is that, okay, I cannot in this case, have the new funding in my balance sheet, and on the other hand, the creditors, they are going to refuse to roll over their debt in this case. And these two of market liquidity risk and the funding liquidity risk play a liquidity spiral effect in this case. So when there is initial loss that to a single financial institution, the creditors observe that the fundamental value of the financial institution is low. They are going to withdraw their money, or they are going to refuse to roll over their debt. And in this case, the financial institution have to sell their assets on the market to raise funds. That is the deleveraging process. And then the price of the asset decline. That give a loss on the existing position of their assets. And then this is spiral again. When the creditors see a loss on the existing position, they are going to withdraw their money, or they are going to refuse to roll over their debt. So this liquidity spiral plays a very, very important role during the financial crisis. So, okay, now we have defined the liquidity risk, that is the market liquidity risk and funding liquidity risk. And the question boils down to the funding liquidity risk, actually, because what the financial institution sell on the market, they are going to, the purpose by doing so is to raising their fund from the market as well. Okay, so what's the difference between the banking sector and the insurance sector from the liquidity risk perspective? Okay, for the banking sector, that we know that the instability comes from the fractional reserve system. Is that I collect all the deposits from the depositor. What I'm going to take as a reserve is just a fraction, a part of the deposit I get. And then I transform this short-term debt to invest into the long-term assets, which is illiquid. And by doing so, I create a maturity mismatch in this case. Okay? And then if there is a bank run, in the paper of Diamond Dipwick 1983, they have identified that there is a multi-equilibrium in this case. The first equilibrium is that, okay, we are fine, people are not going to withdraw their money with respect to their preference. However, during the crisis, if I am a late consumer, I see there are some others to withdraw the bank. I'm going to withdraw early as well. So that creates a funding liquidity problem in the banking sector. And also, from the market side, the supply and demand for the liquidity are inelastic during the short run. This is the cash in the market pricing problem. So there is also another asymmetric information problem issue that may occur in the market is that during the crisis, if I'm going to sell assets on the market, so the others will think that I'm going to sell, the asset I'm going to sell is a toxic asset. This is the asymmetric information we have. So if once the other think I'm going to sell a toxic asset, the liquidity of the asset in the market is freezing. So the problem in insurance is different. Insurers do not rely on massive short-term funding to finance their long-term assets. So what we can say is that insurance companies do not do this maturity mismatch thing. And then, so the withdrawal of the cash is quite stable. That is relevant to the unforeseen events such as a nature catastrophe or something else, or accident. And then, so for this kind of thing, the probability of having a nature catastrophe is quite stable. We are assuming that they follow a law of large number. So in this case, if we just get a part of the reserve on our balance sheet, it's which is quite safe to protect the funding problem in that case. And insurance run are mitigated by the product design. We cannot withdraw the money as we want. If we want to withdraw, we have to wait 1 year or longer. So in that case, it is no longer a short-term liquidity problem. It won't. Hello. Okay. And the last point is that the potential funding risk comes from the non-core activity of the insurance company in that case. I think Emily will elaborate more on this side. So far, what we have talked about is only the idiosyncratic risk. We have not talked about the systemic risk yet. Like all the contagion diseases, the systemic risk comes from also the idiosyncratic risk as well. The systemic risk runs along two dimensions. The first dimension is the time dimension. That is the evolution of the system-wide risk over time. And the cross-sectional dimension is the distribution of the risk within financial system at a given point in time. Okay. So the time dimension is, what is time dimension of the systemic risk? It's the procyclical effect that feedback between the financial system and the real economy, which may amplify the business cycle fluctuation that exacerbates the financial instability. That is exactly what we have seen during the financial crisis as well. So again, I'm going to differentiate the time dimension of the systemic risk from banking sector to insurance sector. Again, the asymmetric information is one of the roots of the procyclicality for the bank. Why is the case? I'm a bank. If I'm going to grant loan into the real economy, I always impose a collateral for the borrowers. And the collateral value is high during the boom, and the collateral value is low during the crisis. If the collateral value is high, I can issue, the borrower can borrow more money. If the collateral value is low, the borrower can borrow less money, which means that the bank injects more liquidity into the market during the boom, and the bank issue less liquidity or inject the fresh blood into the real economy during the downturn. Okay. That is the effect that we call the financial accelerator. Okay. And for the insurance sector, the insurance company do not impose any credit constraints on the economy, and what they do, they are going to invest directly into the financial market. So, in this case, the insurance company don't play a role in the financial accelerator. And also there are some people argue that the shifts in the asset allocation of the insurance company may affect the procyclicality effect. However, this effect for the insurance company is a systematic risk, is not a systemic risk in the case, because the sorry, there's always something. Let's continue. In this case, insurance companies suffer from the systematic risk, which is different, as I defined from the very beginning, the systemic risk. This is because during the downturn, for those who are affected by the funding liquidity risk, they are going to sell their asset on the market. However, for example, there are banks sell their assets. Insurance company see the price decline in that case. They also have the incentive to sell their asset on the market as well. So that's why I say the insurance company suffers from the systematic risk. And there's not only insurance company doing so. There are hedge funds, there are asset managers, and also the households sell the asset in that case. Should we regulate all these institutions, including the household, between you and me? The answer is not obvious either. Okay, so now we turn to the cross-sectional dimension of the systemic risk. For bank, the cross-sectional dimension is obvious. That's what we call domino effect from the interbank lending activity. And also the fair sales externality in that case. I just want to say something more about the fair sales externality is that if I am a company on my balance sheet, I have 2 bananas and 2 apples. Emily is another company on her balance sheet have 2 bananas or 2 oranges. If she has a funding problem, she has to sell is the apple we have as the common asset? Banana, sorry, yeah. So if you sell the banana, I can see the banana price decline. In that case, I'm not going to suffer this risk. I have the willingness to sell my banana on my balance sheet as well. So that's how the fair sales externality occur on the financial market. Okay, and keep in mind, the root for doing so is the funding liquidity risk. If one financial institution don't have the funding liquidity risk, they don't have the willingness to sell their assets massively and actively to raise the fund in that case. And for the insurance, there is no inter-insurance activities in that sector. And it is interesting to think about why there is no inter-insurance activity in the sector. This is because for the bank, they have the liquidity issue. So that's why we have an interbank lending activity. For the insurance company, we don't have the liquidity issue. So there is no need to have inter-insurance activity in the sector. And how the insurance company links to the other financial institution in the financial market, that is by the OTC market. Before the financial crisis, the OTC market is not regulated by the regulator at all. However, in my knowledge, now the OTC market is quite regulated as well. For the bilateral trading, the regulators impose a collateral value for the counterparty as well. So the third and fourth point, the mispricing of the financial asset and the risk have been underestimated. It can be seen as the same thing because the key insight of the underestimate of the insurance coverage economically is similar to the overpaying for assets in that case. But for underestimate the risk is less obvious, of course. So that is the issue. Reminds us should be very, very careful about the risk management business. The next point is that the interconnectedness between the insurance company is typically runs into what we call the shadow insurance business. And at that point in time, before the financial crisis, this sector is just out of the radar of the regulators. So, and the last point is that the insurance company is not the sources of the fire sales. I want to mention again, because the insurance company don't have the funding liquidity problem, they don't have the willingness to actively sell their assets. Why they sell their assets? They have the shift. They shift their asset allocation, as I mentioned earlier, is because they suffer from a systematic risk. What we should do, or what we could do to reduce this kind of risk I think to implement a stress test it would be more efficient, socially efficient than imposing systemic capital surcharge, because the regulation is very costly, as we are seeing nowadays. The central banks, on the one hand, they stimulate the market by weakening the monetary policy, and on the other hand, they just grasp all the financial institutions to put a higher financial regulation on the market. So these two things contradict each other, and really decrease the social efficiency of the monetary policy and as well as the financial regulation. So let me conclude my talk. It's just a resume of what I have mentioned before. Again, the systemic capital surcharge has been imposed on the banking sector. However, what a pity, the FSB doesn't take into account the funding liquidity factor into the systemic capital surcharge. So what I would suggest further, we should pay more attention on the funding liquidity issue, to think about to regulate the financial institution in a systemically way. Thank you very much.